Want your brand to be seen and be remembered? Effective campaigns need both. JC.co's high-quality billboard sites in premium locations nationwide offer brands powerful and visible stages for emotive, impactful and influential storytelling. Find out how JC.co can help your brand be seen and be remembered at www.beseenberemembered.co.nz. Nau mai, hoki mai, kia ora fold, e mihi ne, ko Duncan Grieve, tōku ingoa, and welcoming back Glen Kyne.
Kia ora, Duncan, good to be here.
So, as Glenn was just observing off here, it is something of like a sort of slow news season for the media, but I also think there's some quite interesting stuff bubbling beneath there, which we will get into. We're going to start with drilling into the Netflix results, which are kind of amazing and also have a couple of little watch outs, which explains how you could sort of smash expectations, but also have your stock trade down in the aftermath. So we'll go through that. We're also going to look at the Substack raising $100 million, by far their most substantial sum yet, at a $1.1 billion valuation, what that might mean. And then finally, two much more local stories. One is the final end to this long-running Auckland Transport contract saga, which should be the kind of thing that just doesn't even get noticed in any public forum, but Auckland Transport found a way to make that procurement process very public and acrimonious. And that also folds into, I was at the Beacons Awards, which are the sort of media buying placement awards last Thursday, which is very much connected to that AT contract in a way, which you will see at the time. So those four things. Let's get into it, Glenn. What did you make of the Netflix results?
Oh, that's the company that just keeps on giving, isn't it? Like, they are phenomenal what they continue to pour out, and they always, in their forecasts, I think, are conservative and over-deliver against that and get the rewards accordingly. It was interesting. I just looked at what's their market cap up to now based on their stock price. US $514 billion market cap. In New Zealand dollars, $862 billion. Like, that's nearing $1 trillion company. It is crazy how good that is.
It's interesting, right? Because you sort of look at the sort of mega cap type companies. I read earlier today that NVIDIA, which recently broached $4 trillion, is now bigger than the entire German stock market combined. Which, given that Germany is like the industrial powerhouse of Europe, is quite a terrifying thought.
Well, and it
here
feels
we
like,
are.
and all of the kind of media tech companies, I guess, coming out of the US are probably in for a pretty good ride under, during the, I guess, Trump's term, right? There's going to be little regulation against them in any way that's going to slow them down.
Well, not only that, right? But that he's signalled so powerfully that he will use trade and tariffs as a weapon, and if anyone so much as thinks about trying to tax or regulate or kind of impose any restriction on a US company, he will look upon that very unfavourably. It's a terrifying time to be alive in that respect.
Good time to be Netflix, though.
It's a good time to be Netflix. It's interesting, right, as well, because you think about the other companies that are in that sort of $1 trillion plus range, and they have vastly complex businesses.
Yeah.
Amazon and Meta and Alphabet and Apple, and Netflix is basically one product.
Yep.
Just plays everywhere.
Yep.
And yet it is starting to creep up there in terms of its capitalization. Do you want to just quickly go through those sort of top line numbers that were released before we dig into the what does it all mean of it?
Yep. So revenue for the quarter, $11.1 billion. That's 16% growth, roughly, on the same quarter last year. Earnings per share up to $7.19. The expectation was $7.07, so that's pretty remarkable. They have healthy member growth. Now, remember, they don't report now anymore their numbers, and that's a sign of the business maturity. They want to be treated as a grown-up company, looking at their effectively their trading performance, not necessarily their subscribers as being the only pathway to growth anymore.
It's interesting, though, because it does imply that is, that they might not be able to find top-line number growth quite so easily as they have historically, and they will instead be kind of squeezing their their current customer base.
Well, let's come back to that because we need to talk about what happened to the share price immediately after the results came out. They talked about the momentum in ad revenue, and they've suggested that by the end of this year that will have doubled from same time last year. So that's pretty admirable. Low base, of course, so you expect very, very strong growth.
But also that they will be turning it on in every market in the world.
Well, they've said, that the technology is now deployed in every market in the world. And so does that mean we're going to see something here in New Zealand? I've always been dubious that they would turn it on because this is such a, this is almost 100% profit in the New Zealand market for Netflix.
The only thing that I sort of was reading Tim Burrows in Unmade, and whose conjecture was, and I think it made sense, that with those sort of technology companies that come to a market like this, the smartest thing for them to do is just rent someone else's sales team.
Yep.
And so, might be that WBD is actually, through 3 or a TVNZ, they're sort of a frenemy situation, but someone who's got established relationships with media entities and can just sort of, because you do need some boots on the ground.
You do. I just still question whether they would do it in New Zealand because I'm not sure the cost of investment to go in versus the return they would get anytime soon within a market that's so profitable and dominant the way Netflix are in New Zealand. But we'll see. We'll see. Operating margin, is up to 30%. Media business with operating margins at 30%, extraordinary.
Yeah.
Just extraordinary. The thing that impressed me, and the little technical point, is just the return on equity and cash flow. So for every dollar that they're investing back in, they're getting a 41% return. That is just extraordinary as well. And of course, as we've said, they now focus very much on, their cost base and their revenues in terms of all of the kind of analyst comments they make at quarterly reviews, which just means they're being treated now as a very mature business. What was interesting, though, is that initially, post the earnings call, the stock went up 2%, and then very quickly it dropped 5.1%. And there were a couple of really interesting things behind that, which go back to what you were just talking about, is how much do they need to squeeze out of their base. There was a suggestion that a lot of the revenue growth has come through weak US dollar overseas, and so therefore those overseas markets are overperforming relatively, and that's driven up revenue, and also at the expense of not a lot of growth coming out of the US. And that's actually, if you look at all streaming companies, they've kind of hit this kind of peak almost ceiling in the US around how much they can extract out of that market.
Well, when you think about what the US is a cable market for decades, well, not if not decades, but like for long periods of time, it was in a crazy number of households, something like 80%. But it just sort of sat there. Like there was a particular kind of level you could get to, and beyond that, it wouldn't budge. And it might be that streaming, at least in the aggregate, doesn't mean that they won't trade customers between themselves, but that the total market might be reasonably well determined by this point, which again suggests that there might be trouble coming down if your plan is to show forever growth, which most of these technology companies seek to do.
Well, we talked about this a few weeks ago, the TF1 deal in France. Is that the new future forward strategy of how they're going to think about, driving growth in Netflix as you do saturate, that paid market? The other thing that was interesting just in the share price drop was the, some shareholders clearly profit taking, right, selling down and taking the upside. And also a belief that even though the result outperformed the forecast, some thought that perhaps there should have been more in that.
Yeah, I totally agree. I mean, it's interesting with Netflix, and it's so dangerous to do this in terms of, as a subscriber, analyzing your own behavior and kind of extrapolating from that what millions and millions of other people might be thinking. But I don't know. I'm not loving Netflix anymore. Like, I think it's an amazing product. I would prefer to watch anything on it than any other platform. So from a technology point of view, I'm all over it. But the things I'm watching on it are typically like catalog shows that they didn't even make themselves, coming from other studios. And I thought it was quite telling that this was they alongside this they put out their sort of engagement report, which comes out every 6 months. Amazing thing if you ever get to look at it, because it runs thousands and thousands of titles down to quite. It bottoms out at a particular level, but you can see how almost anything performed globally on Netflix. But the top line number was, as is rarely the case, was actually the most interesting in that, its subscribers watched over 95 billion hours in the first half of 2025, a 1% increase from a year earlier. So they are managing to get 15% increase in revenues and 30% increase in profitability, more than 30% increase in profitability out of a base that is clearly just flatlining in terms of its own engagement with the product. In fact, assuming that they've had some growth in total numbers in that time, it would indicate less consumption on a per audience member basis over that time. And I don't know, that feels a little bit like where Netflix is at in the culture to me, that it has there was that amazing James Poniwozik, New York Times critics, Golden Age of Mid-TV piece a couple of years ago, which I think about a lot, and explained that everyone's shooting for sort of 3 seasons of 3-star TV with, some people you've heard of in it and a great trailer and just not a lot below that. And that's just how watching Netflix feels to me.
I think part of what you're saying is, and I think Netflix has probably got a lot more growth in it. And the reason I say that is they entered the market so cheap, they destroyed the streaming market for anyone else that was trying to get into it. And so their ability to continue to drive price rises across their base as TV is just increasingly becoming a utility. Like, we're gonna substitute the word Netflix for television soon, right? Like, that's how ubiquitous it's becoming, and the deals like TF1 just continue to propagate that. So I think it's got a long runway to go. I think in terms of the user experience and the content output, this is the challenge of when you want to be a growing up company and you've got to manage that cost base and really squeeze it really hard for maximum return versus early days where they were spending far more to get great content out there than what they were actually earning to drive that growth and drive that engagement. And it's this balance, right? Trying to, invest 500 million over here and hope that you'll get 1.2 billion over here around the world, but sometimes those economics just don't work. And if those economics don't work for Netflix anymore, they're going to get penalized for it. So it's really interesting that you make that observation, right? Because I think that is the truth. They are now starting to squeeze their product to try and create as much utility out of it as possible.
Yeah, and I think that to your point about Netflix becoming synonymous with TV, there are still vast parts of the sort of TV ecosystem which doesn't really do a lot of live, though, and it doesn't do a lot of kind of country specific programming. It doesn't do a lot of news. There's obviously a big experiment going on with that in France, which if that comes off, that could change everything. Sports is still very kind of nascent with it. It's spent a lot on games, particularly mobile games, which to me seems increasingly crazy in terms of how fragmented that market is, and
although it increases time engagement with Netflix in theory.
Yeah, exactly. And maybe you get hooked into to a particular game and you find it hard to quit. Some crazy amount of the New York Times' current engagement is basically just word on connections. So it's not a. I guess there is a lot of room for them to grow, and if they keep that amazing technology infrastructure, and if they can start to be like, because say if I could watch Neon through Netflix, I would do that because it's just got this vastly better technological interface, and there's all kinds of strands that they can just sort of pick up. They're not the first thing you do, but they might be the eighth.
Yep.
And that all of that stuff means that Netflix is the last subscription you cancel. And I think that's the sort of place they want to be, and that gives you the ability to sort of slowly push up the price bit by bit by bit, though there has to be a limit to that at some point.
Well, and I think the analysts would agree with you. So they are suggesting that there's maybe the stock price is sitting around $1,200 a share, 1,250, I think. And I think the analysts are saying that based on everything they know and everything that Netflix is telling them, they can see that maybe they can get to $1,350, so another $100, and that's it. At that point, Netflix are going to have to do a lot to convince people that there is another 5, 10, 20 years growth trajectory beyond what they're currently doing.
Yeah. No, it's interesting, right? And from one sort of company which has become a verb to another, and one which made an equally strong statement on advertising, is now looking to walk that back, and that's Substack. Very different. It's it's valued at about 1/500th the scale of Netflix at the moment.
It's a unicorn. It's our new unicorn.
That's right. So Hamish McKenzie, who's appeared on this podcast a couple of times, is the co-founder of Substack and a New Zealander from Alexandra, I think. And that company has delivered a far outsized cultural impact to its kind of financial performance, and that's in part because it has this 90-10 revenue split with the creators that use it. But it's a company that's vastly changed in the, I think, 8 years since it was founded, and that it started out basically being a way for people with a social audience or a newsletter audience to convert that to paying subscribers. Now it does basically most of the functions of any grown-up social media platform. It does that in a there are opinions differ about what Notes is like for people, about the extent to which they prioritized a more social type experience over the long reads that were its foundation. And and Hamish McKenzie has been very forthright, including on this podcast, about never ads, and now they're saying maybe ads.
Well, the underlying thing is there that like a couple of years ago, I think they were 2 million subscribers. Now they're at 5 million plus, and they're kind of at that scale now where ads all of a sudden become attractive. And if they want to keep investing and keep growing, turning on that revenue stream, like we've talked about it so many times, the modern media model needs to be able to tap into both the paywall and the ad market.
Yeah, and I think, without wanting to put words in Hamish's mouth, my guess would be that I think where you have ads as the dominant or the only revenue stream for a user-generated content service, it just pushes you in a particular direction. And where it is the subordinate revenue stream, then I think you should be able to kind of manage it more. And so you've got the situation where the 90-10 rev share means that you've got a formidable moat around you, particularly given that they can now generate extra, they generate really good subscription growth by all accounts for people with Substacks using the various kind of tools that they have to grow databases. But they, both in terms of their own revenues and the revenues for their creators, the 90-10 kind of keeps them in a particular box. They can only grow in a fairly constrained way, but also there are all these people basically using it to put advertising in their newsletter products in particular, but there with no kind of wraparound support for that. So I do think that this makes sense, but it's just how do you keep the genie in the bottle and keep it from kind of pushing you down to the point where you've already made the product quite a lot like social media, and now you might actually start to kind of create incentives which mirror those of the thing that you were set up to destroy. Yeah,
they have to very meaningfully constrain the inventory, I think, to make sure that user experience and that creator experience is maintained. I'm fascinated by this because, like you, for my sins, I spend time thinking about what the future of news is going to look like and how it's going to come to life. And Substack has been, arguably one of the first true global alternatives we're seeing to a mainstream media product that's supporting, where the content creator is the brand and becomes the platform using, obviously, the Substack technology to get to market. And, to see its growth is phenomenal. But what I was really interested in seeing is that where some of this money that they have, the 100 million that they've just raised, where it's going to go. And yes, they talked about ad revenue, but they also talked about getting into live video. And I thought, wow, here we go. Is this going to be where we see the true scaling of Substack by introducing video, particularly live video through content creators, trusted sources, where we see a true alternative to news come to life?
Yeah, they've had live video on their platform for a little while now, but it does feel very creator with a phone kind of is the sort of default level of production. And, I think for them to start to address what YouTube has become, where you can get basically fully professionalized content distributed, from all kinds of different, for everything from legacy players to kind of startups, all within that universe. I think that's still an unknown for them. But again, you just look at 90/10 as a rev share, and you go like, if you're an ABC or CNN, which Mark Thompson, who used to be at the New York Times and BBC, as he's trying to figure out what that is, if you could build that on Substack and kind of start to make that the place where you do paid, maybe that I've always felt like that revenue share was a very powerful thing, the bigger you could get it, and maybe this is the sort of start of them walking down that road. The JC Billboard Network delivers quality reach via commanding sites to ensure your campaign is visible and impactful. With superior screen quality and premium locations, JC can help your campaign be seen and be remembered. Visit www.beseenberemembered.co.nz to learn more. Let's get local here. So this time a week ago, the Auckland Transport is we're talking about the bus shelters effectively.
Buses, street furniture, billboards, number of things associated with the Auckland Transport routes and connections.
So for 25 years, O Media, or its antecedents, which stands for Out of Home, it's an Australian listed entity. They've had that contract within New Zealand, and it was up for tender, and it has just been the most diabolically run process by all accounts, and they've had multiple deadlines missed, and what should have been a fiercely contested but ultimately quite quiet and private contracting process has become a really drawn-out public dogfight. I don't know exactly what the reasons for that are, but it finally came to an end. But my understanding is that the incumbent got a phone call on Monday night saying you didn't get it, and the next morning it was public that it was MediaWorks, a company a form of the company that you used to work for, which is it's a pretty rough way for the. I mean, there's probably no nice way to do it, but it's after such a long process to have a phone call outside of work hours be the way the news was delivered is kind of shocking.
Yeah, it suggests that they were aware of their poor behaviour potentially during the process earlier and doing it out of hours to minimise, obviously, any repercussions in the press cycle, perhaps. Anyway,
makes sense. When you say they, you mean AT?
AT, yeah, AT. First of all, huge congratulations to MediaWorks. Phenomenal result, and we'll get into what it means for them. But also, we have to shout out, I think, Nick Vial, because the grace with which he has handled this, and you can talk in a minute about the beacons, but I saw obviously his post about it, and I thought, it was just so full of grace, and it was a reflection, I think, of Nick as the man, but also showed a lot of care, I think, for his people, because this is a big deal, right? This is the biggest contract in outdoor in New Zealand. The ramifications are extraordinary. There's going to be an impact. To what degree, we don't know. But to see him, be so gracious in the way he managed his comms and those comms was brilliant.
Yeah, I totally agree. And we'll talk about the beacons in a second. But he they were the sort of headline sponsor, and he made the opening speech. And can you imagine a worse assignment? Like, 2 days after you've just been given this kind of pretty devastating news. I think Shane did some kind of sort of back of the envelope maths on it, and it looked like it was something like 40% of their revenues were associated with that contract. So not many people can sustain a loss like that. But he made an amazing speech, and you felt the whole room. Including congratulating MediaWorks on the win, and you felt the whole room kind of wrap their arms around him and the O team, metaphorically speaking, on Thursday at the Beacons. But as you say, for MediaWorks, kind of a transformative win. And again, just like stuff with the Trade Me investment, that's a company that sort of felt like it's back on its heels a bit. Really didn't. Since the decoupling with the TV assets, it's had, tried to do the merger with Sky. That got kind of roundly shouted down. It's had this very reluctant owner for a long period of time, but now with QMS taking that over and with this win, it sort of feels like it's starting to get its energy back under Wendy as CEO.
Yeah, it's a huge win. The effort that goes into something like this is extraordinary. They would have had specialist resource, no doubt, out of Australia, and the QMS team in Australia come and work on the bid with the New Zealand team. It looks, and again, we don't know the exact numbers here, so there's a bit of speculation in this, but it looks to be in total a $350 million deal over 10 years. Remembering, though, that that's not all new revenue to MediaWorks because they already had the bus contract and they already had a number of outdoor assets they were servicing for AT. What is interesting in the deal, two things for me. One, Auckland Transport, this is a good deal for them because they've increased the revenue share that they're getting out of the deal. And so out of that $350 million, it's anticipated that $220 million will go to Auckland Transport.
And that's really the kind of the big change is that previously for the last 25 years, I think that I'm not sure what the split would have been, but it was much more favourable to the sales side effectively. And now, and this is in part probably a result of the kind of councils just being in a much tougher situation, and maybe also in part the digitisation of those outdoor assets, meaning that some of the servicing of that is a bit more light touch than it might previously have been. But yeah, it's a for the ratepayers of the city that's helpful. Yeah. Revenue to have kept flowing in.
I mean, it's definitely good for MediaWorks anyway because it gives them a position of strength and scale in the market that they can leverage off outside of the AT contract. But also the thing for MediaWorks, what happens in these contracts is, there's an expectation, and there will be an expectation on MediaWorks and a commitment, no doubt, that they will have to put a lot of capital in to either upgrade sites, add new sites, and do a number of things. So out of the $130 million that they're retaining out of this agreement, and again, we're speculating a bit on the numbers here, but it'll be interesting to know how much of that actually falls through to the bottom line once all these assets are actually traded. But as I say, the fact that it gives them the scale allows them to leverage that scale elsewhere in the market and have a very, very, very strong out-of-home business.
Yeah, and it's interesting, right? Because out-of-home has been, the big kind of bright spot of locally domiciled media, of non-big tech media locally, and there's been speculation from multiple sources on Friday that this might be a prelude to QMS listing in Australia. And the other interesting thing about it was, oMedia is listed, and you'd think a loss of a contract, even though it's got a much bigger business in Australia than in New Zealand, still it's a big contract to lose, but the share price barely budged and, in fact, ended the week up. So obviously that had been both priced in, but also wasn't considered materially significant enough for O, which has had a pretty good run up over the past 6 months.
Yeah, well, I mean, these contracts, they take a lot of resource and effort to fulfill them and to manage them, right? And so, and obviously the capital that goes in to keep them relevant and salient. And from O's perspective, even though they've lost this contract, and yes, it's a big loss, and yes, it's a loss of revenue, it's capital they don't need to deploy into that contract now. They can deploy capital elsewhere. And so they will be looking at what those other growth opportunities are. And no doubt they will know because they would have thought about what the counterfactual of this was going to be at the time they made the bid. And so I don't think this is necessarily a bad outcome. It's certainly going to change direction. It's going to give them some operating flexibility to do some other things. And I've got no doubt they'll come out of the gates well.
Yeah, it's interesting. So I was at table with some of the O team on Thursday and spoke to them quite a bit, and there was this sense of, like as much as it was a tough blow, there was, there's that thing that happens within a team when something like this goes on, and you kind of understand that you're playing for keeps and you're going to have to battle, and there's a bit of excitement with that, like
freedom almost.
Yeah, exactly. Like we can figure this thing out on our own, and you certainly got that sense from them. The other thing, before we move on to the beacons, is it's just you look at outdoor media, and you've got JC Decaux, who who's sponsored this podcast, Media, who previously sponsored it, so that's by way of conflict declaration. But you also have MediaWorks, obviously. You've got Go
Lumo.
Media. You've got Lumo. You've got Udo, who've just started up recently. There's competition.
Yes.
And it's an interesting thing, right?
And there's still growth in terms of the inventory that can be put into the market.
Right. And I just sort of think that when you look at so much of the sort of what we talk about in this podcast is a giant technology companies that have effective monopolies over aspects of the sort of digital infrastructure and consumer experience, and the rise of AI, which seems to be shrinking that even further, even though there is meaningful competition within the sort of the platforms space. But to see in a local market with a bunch of people competing on in different ways, just how vibrant and dynamic it becomes when you have that. You're like, oh man.
Well, it's one of the I remember when time at MediaWorks when we were looking to do the merger with QMS, and there were so many attractions that I learned about, and became excited about the outdoor business. One is no cost of content, right? So from a traditional business, you don't have this legacy content cost that you're carrying. It's a pure advertising business. Secondly, the conversion from a traditional static billboard to a digital billboard works infinitely well for an outdoor company compared to other media. The ability to get 6 to 8 rotations of an ad per minute on a screen versus one that's stuck there for a month.
And hold the price.
Right. And so and the innovation that you can now add to these screens, and it was increasingly at the time, and now no doubt very much treated as an alternative to TV, almost treated like a broadcast media, because you could push out, in real time these ad units that were doing incredible things. And so it's a really exciting business. I think the future is very, very bright. Congrats, MediaWorks. Best of luck, Nick, and the O team. I'm sure they'll do well. But Beacons, so you were there.
Yeah.
Tell us about it.
So my second time at the Beacons, second time in 3 years. The first time I went, I have to say, was kind of a eye-opening experience. It was in a theatre. I think it was in the Aotea Centre, and I think they blasted through the whole thing like 45 minutes. There wasn't a lot of attention paid to what was going on stage.
Possibly after a few years prior, where the winners would speak for a very, very long time on stage, and the awards would go for an enormously long time.
Awards are difficult, right? But it also felt like they were just trying to get through them because the real show was the after party.
Of course.
Whereas this time around, it was tables, and there was like really funny comms went around in advance. Simon Lindrum from the Comms Council basically saying, we'll be watching you, and no outside booze, no drugs, like just kind of hold it together. And honestly, I think that the message was received. Like the this is a young crowd. It's largely people from agencies or sales teams of bigger media companies, and
it's their night of nights, right?
And it's their night of nights, and honestly, like fair play to them. And you have to say that media buying is just a vastly more complex, or there's much more room for different approaches than there was in the pre-digital era. So it was hosted by Clint Roberts. There wasn't a big sense of the show, and there weren't a lot of speeches, but it kind of you got a sense of what the industry's trying to deal with in terms of like the sort of different kind of approaches to a media problem that you can that you can take now.
What was the mood of the room, Duncan, in terms of the outlook?
The mood was pretty buoyant.
Yep.
I think there's definitely like more so than the kind of media operator side.
Yep.
So and I think that probably reflects the fact that the digital side, the big technology side, continues to drive growth in the overall spend area, even if not its share of that is growing. by the day. That's obviously something that's of consuming interest to people like me. But if you just think about their aspect of, the media agency side of the industry, that's, they basically, that's of less interest than the sort of the total billings. Nick's speech to open up kind of set the tone, and there was just a general kind of sense of decorum about it that wasn't necessarily there, like I said. But in terms of the big wins, NBN won a ton of awards for their Vogel's campaign, which basically turned the toaster aisle into a piece of media. That sometimes you're like, the level of creativity in the media thing can feel a bit stunty. This was that, but I think it was also actually a pretty decent kind of execution. Media Agency of the Year was Lasso, which, so for an indie,
fantastic,
relatively small, to come in against all the holding companies which dominate the industry was, you could just see that meant so much to that group.
Congrats, Bridget and Daniel. That's a great win. Yep.
And similar, Media Business of the Year was Stuff, big sales team on stage there.
It kind of just felt fitting, just the positive momentum that's sitting with Stuff. Like it was like, okay, this is all making sense in this, in a way that there's just been so much positive news about Stuff in recent times.
Yeah, absolutely. And while the Trade Me thing is they barely scratched the surface of what that integration can mean, yet that remains something that's really sort of wide open for them. And I think a win like this sort of serves to sort of nod at that potential, I suppose. Sales team of the years with Sky, that you just can't refute. Like if you look at what that advertising business has always been, like a massive underperformer versus the audience share of Sky, incredible what they've managed to do in this really difficult market, and kind of a sort of suggests to probably some of the other big media operators that if you're really determined, there's wins you can find.
Yeah, and they're really getting their act together on the digital front as well. And I think absolutely well deserved. Shows in their latest results. I'm sure we'll see it upcoming in their next set of results as well. But also, let's not forget they're up against some very, very, very good sales teams. The NZME sales team, the Stuff sales team, the TVNZ sales team. These teams are excellent. And so for Sky to win this is a big deal. Again, congrats to Lauren and to Ben and the team. It's phenomenal.
Absolutely. So yeah, and then James Davidson won the Inspiring Individuals. James is someone I know reasonably well. A strategist at PhD who really just loves media, kind of the same way that we talk about it on here. And they had this video to ahead of his win that was went on for honestly, it felt like a really long time, but it did speak to just the kind of depth of feeling within PhD for him. It's interesting, right? Because at the same time, you're seeing the holding companies kind of going through this period of, I don't know, there's something kind of flattening about what they seem to be doing to some of the individual brands. Like I've heard that I think a couple of the different holding companies are now forcing a single email address kind of style across the whole of all of these different sub-brands within it, which might seem like a small thing, but it's quite powerful in terms of how people within those companies, they feel like they work for independent units with an overall owner, or are the brands pretty thin. And if yes, there was a positivity about the whole of the industry, but there's also a little bit of a sense of why are they doing this and what's really happening here? And I think if you think about all the kind of AI as media planner kind of conversation that's in the air as well, that's just seeing that happen to your inbox alone would just kind of start to just freak you out a little, I'd say.
Yeah, and it's just, I guess there is some consistency there with what's happening on the media owner side, and that, the global trading houses, they're under pressure with AI coming and other things to manage their costs and generate profit. And around the world, markets like New Zealand are a profit centre, right? They have to do everything they can to maintain that profit. And you've seen agencies, they continue to morph and change shape all the time as they whether it's the model with which they engage their end clients, whether it's principal media deals, the different ways that they are able to accumulate and make money is continuously changing, all because of that pressure that's coming from different trading models and alternatives out there.
Yeah, absolutely. So look, it was a fun night. Sit down dinner at the Viaduct event centre, a lot more formal than it maybe has been, and I think the better for it.
How was the after party?
I skipped the after party. I think that's for the the young people from the industry, but I'm sure it was full noise. One kind of small note, which I think speaks to why there's something challenging fundamentally about the array of different awards that run out of Communications Council. So the Motion Sickness, who I don't think were there on the night, they did pick up an award. It was a bronze for Make New Zealand the best place in the world to have herpes, and which is a campaign that won a gold lion in Cannes recently, has been talked about everywhere, not just in the kind of trade press, but I was reading about it on The Economist recently. Like it's a really, really smart piece of work, and yet it lost to, like, I think it was, I'm pretty sure it was in the same category or at least an adjacent one, 20 hours of childcare for $20 kind of digital banners. And you're sort of like, I don't know. Yeah, like this is about media placements, right? And they probably had the tiniest media budget or pretty close to it. But then you look at the way that Motion Sickness and Special PR in particular are sort of leveraging a brilliant idea to kind of make media spend sort of almost immaterial, and you sort of wonder, like when you look at the sort of PR awards and the beacons, is there that they're on some level making different arguments, and not everyone can have an idea like that, or not every job can be accomplished that way. But there was something about seeing like this kind of globally recognized campaign just sort of languishing on the stage. It just felt like it raised some challenges or questions out of it.
Yeah, I think part of the challenge is the different awards are not all understood in terms of what they are recognising. And the beacons is very much about media effectiveness and how effective, if you look at the brief, what was desired from that campaign and what happened. I mean, that's the core of how these people have won, because they've been the most effective in that category. Whereas I think, the campaign you're referring to, and I'm not saying it wasn't effective at all. I mean, clearly it has had a massive impact, right, to win, a Cannes Gold. But did it change the consumer behaviour the way they wanted the brief to, or get that outcome? I don't know.
Well, I mean, I think that the hard thing is, like, did the PR from it change the behaviour, or did the media placement? So it just gets quite finely sliced, I suppose. But look, it was a fun time, and this has been a fun podcast. Thank you, Glenn.
Yeah, thanks, Duncan. Good.
Thanks, Tia here. Really appreciate it. Seeing is not enough. With optimized data tools and insights, the JC2Co Billboard Network helps brands be remembered. Dedicated to closing the loop between impression and action, JC2Co can help your campaign be seen and be remembered. Visit www.beseenberemembered.co.nz to learn more.